In early December 2025, China's currency, the yuan, hit a 14-month high against the US dollar, drawing global attention. This sudden surge in value was unexpected, catching many investors and analysts off guard. The financial world quickly turned its focus to China, eager to understand what was driving this dramatic appreciation, and what it might mean for the broader global economy. Observers noticed the yuan's rapid appreciation, which can signal economic strength but also brings challenges. A stronger yuan can make Chinese exports more expensive, potentially impacting the country's massive manufacturing sector and its trade partners. At the same time, it can attract foreign investment, as global investors seek to benefit from the currency's momentum. Sensing the pace was too fast, Chinese authorities responded. They recognized that unchecked currency movements could destabilize markets and disrupt economic planning, both at home and abroad. Major state-owned banks began buying large amounts of US dollars in the onshore market, a move described as unusually forceful. This was not a routine intervention, but a clear signal that the government was willing to act decisively to manage the yuan's trajectory. The aim: slow the yuan's rally by boosting dollar demand and tempering the yuan's rise. By increasing the supply of yuan and buying up dollars, authorities hope to restore balance and prevent excessive volatility in the currency markets. This intervention showed that China's currency isn't left entirely to market forces. Authorities step in to keep movements orderly. The government's willingness to intervene reassured some market participants, while raising questions for others about the future direction of policy. The yuan had already gained over 3% against the dollar that year, its best run since 2020. This impressive performance underscored China's growing influence in the global financial system. As the world's second-largest economy, China's currency moves ripple through global trade, affecting prices and investment strategies worldwide. Companies, investors, and governments all pay close attention to these shifts, knowing they can impact everything from commodity prices to international investment flows. This wasn't just a technical tweak, it was a strategic decision with global implications. The move signaled China's intent to maintain stability and assert control over its financial destiny, even as it engages with the wider world. The world watched closely, wondering what China's next move would be in this high-stakes financial dance. With so much at stake, every decision in Beijing has the potential to send ripples across the globe, shaping the future of international finance. To understand this intervention, you need to know who's in charge. China's major state-owned banks, directed by the government, are the main actors. These banks execute policy directives from the People's Bank of China, or PBOC, the country's central bank.
The PBOC can guide or instruct these banks to act in the currency markets, often behind the scenes. This allows for subtle, coordinated interventions without the central bank acting directly. While state banks sometimes trade for their own interests, the scale and timing here pointed to official policy.
This structure gives China a powerful toolkit. Unlike Western central banks, the PBOC can act quickly and decisively through its state banks. When the yuan moves too fast, China can step in directly, showing a level of control few nations can match. In response to the yuan's rapid appreciation, China's state-owned banks stepped in and began buying US dollars in the onshore market. This move increased demand for the greenback and helped slow the yuan's rise, sending a clear signal to the market that authorities were ready to act. What stood out this time was a notable shift in tactics, a departure from the playbook used in previous episodes of currency volatility. In the past, after buying dollars, banks would typically recycle those funds back into the market through currency swaps, ensuring that liquidity kept flowing and the market remained stable.
This time, however, they held onto the dollars instead of releasing them. By keeping the dollars in their vaults, they effectively tightened dollar liquidity within China, making US dollars harder to come by for local traders and institutions.
With fewer dollars circulating in the system, it became significantly more expensive for traders to bet against the dollar and on a rising yuan. This scarcity raised the cost of making speculative trades. This clever and calculated move discouraged speculative bets that could have pushed the yuan too high, too quickly, potentially destabilizing the market.
The authorities weren't trying to reverse the yuan's overall trend. Instead, their goal was to slow the pace of appreciation and keep the process as orderly as possible, avoiding sudden shocks.
By making it costlier and riskier to speculate, the authorities sent a strong message to both domestic and international traders. China signaled a more determined and proactive effort to moderate the currency's rally, showing that they were willing to use new tools to manage the situation. The ultimate goal was a gradual, controlled appreciation of the yuan, avoiding the kind of volatility that could disrupt economic planning, business confidence, and long-term investment. This was about changing incentives for market participants, not just nudging the exchange rate for a day or two. It was a strategic move to reshape expectations. The message was clear. Speculation would come at a price, and the authorities were prepared to defend stability in the currency market for the long haul. Let's break down some key terms to understand China's actions in the global currency market. The world of finance can seem like a maze of jargon, but once you grasp the basics, it becomes much easier to follow the story behind the headlines. Appreciation means the yuan is getting stronger. Each yuan buys more dollars. In other words, the value of the yuan rises compared to the US dollar, making it more powerful on the international stage.
That's great for Chinese tourists abroad, who find their money goes further when shopping or traveling. But it's tough for exporters, whose goods become pricier overseas, making them less competitive in foreign markets. This can impact everything from electronics to clothing and even the global supply chain.
Liquidity is how easily dollars can be bought or sold. Think of it as the financial system's ability to provide cash when needed, like oil that keeps the economic engine running smoothly. When state banks hold on to dollars, liquidity tightens, making dollars scarcer and more expensive to borrow. This can ripple through the market, affecting businesses and investors who rely on access to foreign currency.
This makes it harder and costlier for investors to bet on a rising yuan. Speculators may think twice before making risky moves, knowing that access to dollars is limited and expensive.
The People's Bank of China, or PBOC, also sets a daily midpoint for the yuan's exchange rate, allowing it to trade within a narrow band. This midpoint acts as a reference point, guiding the currency's movement each day. By setting a stronger midpoint, the PBOC guides the yuan upward, but interventions like this week's help smooth out the ride. These actions prevent sudden swings that could unsettle markets or disrupt trade.
The authorities want to cool speculative fervor by raising the cost of betting on the yuan. By making it more expensive to gamble on currency movements, they hope to discourage short-term speculation and promote stability.
It's about keeping the market balanced. Too much enthusiasm can lead to bubbles and instability. When markets overheat, the consequences can be felt far beyond China's borders, affecting global investors and economies. The intervention was a complementary tool to the daily midpoint, ensuring the rise didn't get out of hand. It's a way for regulators to fine-tune the market, using both rules and real-time actions.
In short, China uses both direct action and policy signals to manage the yuan's path. This dual approach helps maintain control while allowing some flexibility for market forces.
The result is a currency that moves, but not too fast for comfort. It's a system designed to avoid shocks and keep the economy on a steady course. It's a delicate balancing act, one that requires constant attention, careful adjustments, and a deep understanding of the language of money.
China's main goal is stability. Rapid currency moves create uncertainty for businesses and investors.
A fast appreciating yuan can shrink debt burdens for some, but erode the value of dollar assets for others.
Predictable exchange rates make for a more stable economic environment.
China prefers gradual managed change over wild swings.
The authorities aren't against a stronger yuan, but want to control the pace to avoid bubbles and panic.
If exporters expect only gradual gains, they won't rush to convert foreign earnings, which could otherwise fuel more volatility.
Smoothing the path helps businesses plan and prevents herd behavior that destabilizes markets.
For China's leaders, stability underpins growth and social cohesion. Using state banks to fine-tune the exchange rate is a prudent way to steer the economy through global uncertainty. Protecting exports is another key reason for intervention. When the yuan strengthens, Chinese goods become more expensive abroad, threatening competitiveness.
Exports still employ millions and drive growth. Sharp appreciation could hurt manufacturers, especially smaller ones.
By slowing the yuan's rise, authorities give exporters time to adapt, improve efficiency, or move up the value chain.
The goal isn't to keep the yuan weak forever, but to manage the transition without shocking the economy.
It's a balancing act, curbing inflation and signaling strength while protecting jobs and industries. The government is choosing a middle path, gradual appreciation, not abrupt change. China's currency strategy is also about the yuan's global role. For decades, the US dollar has dominated world trade and reserves.
China wants the yuan to be seen as stable and reliable, a currency worthy of international trust.
By smoothing out the yuan's moves, the PBOC shows it's a managed, not volatile currency.
Gradual appreciation attracts foreign investors seeking steady returns, boosting the yuan's global appeal.
This encourages more trade and investment in yuan, slowly increasing its international footprint. China isn't trying to dethrone the dollar overnight, but to build a multipolar currency world.
Every intervention is a step toward making the yuan a true global player.
Stability and predictability are key to elevating the yuan's status on the world stage. The intervention had an immediate effect. The yuan's rally paused, retreating slightly from its peak.
The move didn't trigger a reversal. The yuan remained strong, but the pace slowed. The authorities' goal was to manage the ascent, not weaken the currency.
Traders got the message. Speculative buying cooled as the risk of policy pushback grew.
The action reminded global markets that China's exchange rate is managed, not free-floating. Tighter dollar liquidity made it costlier to bet on the yuan, shifting incentives. Despite intervention, the yuan was still on track for its best year in 5.
The authorities pruned the rally, not uprooted it. The story of a strengthening yuan continues.
China's move to slow the yuan's rise matters globally, affecting trade, inflation, and investment.
For multinationals, it adds unpredictability. Policy, not just markets, drives currency moves in China.
For investors, it's a warning. Easy bets on a rising yuan are over. Watch for official signals.
China will likely allow further appreciation if fundamentals support it, but will intervene to prevent disorderly moves. The strategy managed appreciation, supporting yuan internationalization without domestic disruption.
This week's events were a clear statement. China is committed to controlling its economic destiny.
How China manages the yuan will remain a central story in global finance, with consequences for everyone.